Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Thursday, January 28th, 2021. And here are our top stories. What does retirement customization look like in 2021? And we'll take a look at what's ahead on the regulatory and legislative front. Joining me now to discuss this and a lot more is Randy Plavaika. He's a journalist with Fund Intelligence. Randy, Happy New Year. Great to see you. Thanks for joining us on the program this morning.
Happy New Year to you as well. Thanks so much for having me, and glad to be here.
Yeah, absolutely. Let's talk about 2021. I know you write about the retirement industry often. This is the year of retirement customization, or at least I know that that's what you've reported. So give us the skinny on that. What does that mean, retirement customization?
Yeah, I think this year what we're really going to see is a lot more efforts around personalization and making the experience tailored to individual customers. And that just doesn't apply to the ultra wealthy. That applies to everyday people like you and myself who come in with a basic understanding of what we need out of our 401k, out of our target date funds, or a Roth account. And really what it's going to be is our asset managers, our investment managers, and our record keepers are going to be coming in to step in and offer advice as and when we need it. It won't be hands-on all the time. But really what it will be is more of an approach that works for us, right? As we know, nobody's financial situation is the same these days, although we do have similar standings across demographics. Everybody's going to want something different out of their retirement. Not everybody wants to have, the $2 million banked for the golden egg per se. Some people want to just live sustainably off the land in their retirement. Some people want to go all out. I mean, there's a whole varying, a sliding scale, if you will, of needs that people have in retirement. And addressing those will be top priority for a lot of these firms.
So Randy, when it comes to, let's break it down a little bit. Let's start talking about target date funds. So how does the customization get applied to target date funds? Because target date funds by definition are mutual funds, collective investment trusts, even separate accounts, and they may be specifically designed for a specific population, but generally to this point, they have not been designed for just one individual like you or myself.
Yeah, customization on that end will happen in a few different ways. I'll drill down on the first being retirement income, and the second will be around blended options. So retirement income, as we know, bringing annuities or guaranteed income into the target date picture is a little bit more possible now with the Secure Act being passed. And you see a lot more product development happening there with a lot of firms, and that's happening across the board, not just our largest asset managers, but also people on the boutique side, people that really just want to have a customized solution that maybe don't have, $1 trillion in asset management. They might have 50 or 100. Point being, they really all want to incorporate a layer of basically decumulation into their target date funds, whereas target dates are great for accumulation and have been really well suited for that. Nowadays, people are reframing their thinking, to be more around how can we help these people decumulate their assets and really distribute them properly over time. So it mirrors something like a pension plan or a defined benefit plan of days past. On the other front, right, blended options. We're seeing a lot more managers now looking to bring a passive investing into their traditionally all active TDF offering. What that means is basically a lower price to the customer, but also you get some security and some stability in the indexes that have done well and have, for the most part, measured up to their benchmarks and performed well, even in down markets, right? So I think what everybody wants is, to avoid the risk of either A, losing all your money, or B, taking a massive hit a couple years out before retirement. As we both know, you take a couple years out of retirement, you take a hit then, it's really going to veer you off course and maybe keep you in the workforce longer than you want to be before you're either A, on the beach enjoying your retirement, or C, I guess, on the golf course.
Yeah, that golf course is sounding better and better, assuming we can. The weather's nice. Randy, let's talk about what record keepers and maybe consultants are doing, because in a lot of ways, they are tied together in some ways. Let's talk about managed accounts. You and I have talked about this, I think, ad nauseum probably for 24 months, if not more than that. We have seen considerable growth in the managed account arena, but also consultants are adopting these products as well.
Yeah, it's really interesting to see how advisors and sponsors and consultants overall have really shown an interest here. I wouldn't say it's an avalanche effect by any means, but it's definitely growing. And really what's helping that is a lot of education coming from the record keeping side, a lot of education coming from the investment management side, basically demystifying what goes into making a managed account happen, how the personalization works, and how it can be beneficial to basically a consultant's practice. I would say, education is going to continue to be kind of a driving force for adoption and engagement, unless we get some regulation or some type of legislation that says have at it, managed accounts or status quo, and we can all go forward at that point.
But they have gotten more popular, and more people, to your point and to the point of this segment, which is more people are realizing that they have different needs, and therefore that customization ability of the managed account really is kind of fits that in a lot of ways.
Exactly. I think to your point, Jeff, as well, you're seeing a lot more people that either A, want to be more aggressive with their retirement funds and basically sustain their income for longer because they're A, planning on living longer, or B, they want to give back more to generations after them. Or I guess in the other end of the pool, they also want to be maybe a bit more conservative, right? I think 2020 was an interesting inflection point, especially in March when we saw that big market dislocation from the ongoing pandemic. And all of a sudden it puts it into perspective for people that, if we were to have another, any kind of global crisis, be it financial or social, anything to that accord, you really want to have your savings protected in some way or another. And, just putting it off into a Roth account, 401k, target date fund, et cetera, at this point, and I think managed accounts really present kind of an added layer of safety almost, and almost an added layer of customization, again, touching on that retirement customization point that people want these days. And that will really help fuel their growth to and through retirement, which is a very key point. You'll hear a lot of record keepers marketing their products as being both to and through these days. And obviously I'm no different since I picked up their lingo, but it really is the crucial selling point is that managed accounts, really are there to not only get you to the point of, but then basically to sustain you after into retirement, and really present you a very sustainable way of basically being retired as opposed to having to worry about your savings, 10, 15 years after you've left the workforce.
Randy, what about tools like Robinhood, Betterment, and Personal Capital, which was acquired by Empower Retirement, I think, in 2020? Do those play a role? And maybe they're not part, I guess in the case of Personal Capital, maybe they're part of the Empower Retirement solution, but do you see that those products, those services, Acorns is another, I mean, I don't want to get in trouble for not naming all of them. I'm just giving examples to, don't call. But, are those examples where those products and services are being used in order to provide some additional layer of maybe information and also management for things outside of the retirement plan?
Yeah, and I think to maybe speak from more of my demographic, right? A lot of my friends tend to use those apps to basically do some type of trading that either A, makes them feel kind of good about their finances and activities, or B, to kind of almost get some training in advance, if that sounds appropriate. But really, for a lot of people more my age, Acorn and your Betterments and et cetera of the world can basically go on an app and invest. I'm not sure how seriously those have been taken quite yet as a means of basically supplementing retirement these days, right? Because the amount of money people are putting onto those platforms, if they're in the younger age brackets, tends to be a lot less significant than per se if you're 40 and well developed and well versed in trading, or in general being on the apps and doing some type of online trade. And I think it really comes down to at this point I view it more supplemental. I do see there being power in those apps and definitely some potential in those platforms, basically fueling the retirement journey. To what extent at this point, I'm not really sure, but I would definitely be interested in more data analysis around that, and we'll definitely keep my eyes on that space for sure.
Well, Randy, I want to take a quick break. When we come back, we'll talk to Randy about some of the legislative and regulatory priorities in 2021. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Hi folks, Joe Namath here, and if you're on Medicare, this is important. You're now entitled to eliminate copays and get dental care, dentures, eyeglasses, prescription coverage, in-home aids, unlimited transportation, and home-delivered meals, all at no additional cost. Plus, your zip code may have coverage with the Give Back benefit that adds money back to your Social Security check every month. Look, with the uncertainty of the virus and vaccines, you need to get everything you're entitled to. Here's the bottom line. Call to get significant benefits at no additional cost and see if your zip code has coverage with the Give Back benefit. Millions of people have trusted the Medicare Coverage Helpline. You can too. Call now. It's free.
Call 1-800-924-3920. That's 1-800-924-3920.
Welcome back. We're talking to Randy Plovica of Fund Intelligence. Randy, thank you so much for staying with us this morning.
Of course, Jeff. Thanks for having me back.
Yeah, it's great. So let's shift gears from customization within the retirement industry. Again, very important. It requires legislative and a lot of times regulatory aspects to be updated. And let's switch gears to 2021's regulatory and legislative priorities. You and I spoke all throughout 2020, both on the podcast and also on the network, about the CARES Act and the Secure Act. But where do things stand today with some of the regulatory and legislative priorities?
Yeah, I think something that's really interesting is basically the development of pooled employer plans, or PEPs as we know them, especially within the record-keeping space. To your point, Jeff, there's been a lot more developments there and a lot more guidance given at this point about how to basically administer them, how they work. A lot of your defined benefit players already know how to operate a multi-employer plan, and pooled employer plans are, a little bit different, but do require some of that same expertise. So I think something that I've seen that's really interesting is you're going to see a lot more partnerships around PEPs, and especially the servicing and basically offering of PEPs, right? Because I don't think there's any record keeper, as far as I know right now, and I could, be knocking on wood or checking my windows for like a messenger bird coming in to deliver this news instead. But point being, I don't know of any record keepers right now that want to do every single aspect of the pooled employer planning servicing. So the admin, the offering of the funds, the fiduciary responsibilities, everything that comes with being a PEP provider. I think what we're going to see there, like I said before, is a lot more partnerships, whether it's asset managers coming in, consultants coming in, large RIAs coming in, and making a name or footprint for themselves alongside key record keepers. I would definitely see, your big record keepers, Empower, Fidelity, and a few other retirement players making a name for themselves there. To what extent at this point, it's really not too certain. There are a few providers that have already launched a pooled employer plan, Voya being the first to get their name out there with Aon. So a really interesting conversation around what role does insurance providers and administrators play in this field. At this point, PEPs are going to be kind of weird. I think adoption is going to be gradually upticking, but I don't expect an avalanche per se. Even with all the regulatory basically guidance we've received so far and the allowance for PEPs. Aside from that, the only thing I think I could add to that conversation there is I think there's definitely a need for it, especially among the small micro plan market, to basically make them, available and get them up to par with some of their mid-size and large tiered plans. And really what that'll do is benefit the actual retirement investor, right? It'll bring their fees down a bit, bring the investment down a bit for overall plans. In theory, it should benefit the actual people in the PEP as opposed to just leaving them stranded in the micro or small market.
Yeah, and the theme here, Randy, is really how to provide access. There are many small employers that can't afford, or it's too cost prohibitive to offer a 401k plan, And so how do you provide access to those maybe working in small businesses? Another area that we've seen, and I want to get your thoughts on this, secured choice plans that kind of mirror what is being done in Oregon, California, Illinois. We saw Virginia, I think, the Commonwealth of Virginia saying that they're interested in launching a secure choice plan. How does that look, relative to the private sector solution? Are you seeing uptick in interest in that?
I think there's more conversations being had around it now as far as like actual launches that I can foresee happening in the next few months here. That's a bit of mixed bag per se, and not to just be vague about it, but really at this point, I think it's going to take a lot of basically measured approaches from different states, because every single state system and state plan is going to have a different tailored approach, right? Not to generalize and stereotype my home state of California, but sustainable investing is going to be top of mind for them, right? They're going to want to know how they can do some type of ESG investing within their state offered plan, right? And I think at this point, Chicago and Oregon might be Illinois and Oregon might be in a similar boat. But to what extent we see quote unquote customization at the state level will really be interesting. I don't think there's going to be one approach that, triumphs above all the other ones. But I think at this point right now, there's a lot of different record keepers probably looking to do that sort of work, especially, we have firms that on the technology side, a Census, for example, works with a lot of state and local governments. I could definitely see a firm like them and their peers coming and making a name for themselves as basically being the provider of choice and really the basically creator of choice for these types of plans.
And Randy, we've got obviously a new Congress, new Senate, new president, maybe some different priorities in terms of policy. But the one thing that I think, it's been a pretty divisive year. But the one thing I think that I'm seeing that unites a lot of people in the Congress and the House and the Senate and in the White House is retirement policy. That's the one thing that I think everyone can agree on. We need something to strengthen retirement security for all Americans and strengthen things like Social Security, Medicare, and some of the other transfer programs. What can you tell us there? Is that your sense from talking to people who are working on the Hill on behalf of the industry?
Yeah, I think what's really interesting is that in the past prior administration, retirement legislation, like you said, was one of the only few things we get bipartisan support behind. I think that's going to continue to ring true, especially under I would say a newly balanced legislative body, a new administration. Right, we now have Janet Yellen, Treasury Secretary, confirmed, I believe, today. Stuff to that accord, right? I think under this new administration, we're going to continue to see that furthered. I would expect and I would hope maybe Social Security gets some type of boost. I know that obviously it's always in the forefront of conversation when it comes to securing retirement for especially people in a little bit older demographics. But I think the conversation needs to be around how do we make it so it's basically viable and sustainable for Gen X, for millennials, and even for Gen Z. What does the system need to do to change in order to make that happen? I think those conversations will be had this year and obviously continuing onward as those kind of demographics age upward. My point being, I think there's going to be a lot of positive movement there, potentially a secure 2.0 type situation where maybe we get more meaningful legislation after, a pretty significant gap between the last time we had significant retirement legislation, which would have been back in, I believe, 06, 03-ish territory. Stuff to that accord, right? So I definitely see it continuing. What it actually looks like is still up in the air a bit. I know I've seen some stuff introduced around strengthening defined benefit plans, strengthening pensions overall, and that gives me a lot of hope that they'll then turn their eye to defined contribution plans, which, as we both know, have become more in favor across the larger American population just because of how they're being offered and how they're being tailored. I would hope that obviously we get a secure 2.0 and that it really ultimately benefits the end participant. We can help record keepers and investment managers all we want, but at the end of the day, it's really going to matter about how the average American retires and not so much about how the investment manager retires.
Yeah, well, it's certainly going to be an interesting year. It's only January, the end of January, so we'll have to see how things go. Certainly, we need to not only strengthen retirement, also strengthen small businesses and some other areas. Randy, a pleasure talking to you as well. I want to thank you so much for joining us, and we look forward to having you back on the program again very soon.
Thanks, Jeff.
Well, that wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, then drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, all in one place. Check out today's edition of The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.